Well, thank you very much. Hopefully you can hear me. It's a pleasure being here today, and I appreciate the invitation very much. I am a bit of an outlier in the sense that my economics background is probably mostly, I would have been much better educated if I had spent more time sitting at Charles's feet, but I'm primarily a lawyer, and as Rosa noted, a former regulator, and now I help define where the loopholes are, so for clients. I view it more as defining where flexibility is rather than loopholes. Oh, okay, that's always a danger. People may prefer not to have to listen to me. Yes, I decided, I actually did not receive the, or I did not initiate the title of my initial portion, because when I looked at the title and started working on the paper, I decided that the Basel rules anti-American seemed kind of silly in a sense. We do a lot of things and talk about a lot of things in U.S. politics today that are silly and viewing things as being anti-American. So I thought I would focus a little bit more on what the American role has been in the Basel Committee and other international standard setters, because actually this is something to me that's very, very important going forward, because I think the U.S. has played a very strong role in international standard setting bodies over the last 70 years, really, since the Second World War, and I think has overall been a positive influence. Certainly has at times pushed standards that the international community would not prefer, and that's part of the international standard setting process. But in the U.S. it's become something that to me would, like I said, would seem to me to be as obvious as the nose on your face, that international coordination in the financial regulations and standards that are being set is kind of critical to a well-functioning international financial system, and critical to the effectiveness and the value that the U.S. and other countries have in their own financial systems. But it's sometimes under challenge for rather narrow political interests. So I thought I would start off with a little entertaining, or I should say start off with quotations from a letter that I mentioned in my paper from a representative from the great state of North Carolina, which is where I hail from. Which reflects a little bit of the, speaking of former chairman of the Federal Reserve, a phrase he utilized, irrational exuberance, that sometimes afflicts those who have just taken over the reins of government, where he's instructing the chairman of the Federal Reserve that there should be prioritizing America's interest in international negotiations. It appears that the Federal Reserve continues negotiating international regulatory standards. I'm emphasizing head movements for the outrage. In international negotiations, it appears that the Federal Reserve continues negotiating international regulatory standards for financial institutions among global bureaucrats. God, hate those people. In foreign lands without transparency, accountability, or the authority to do so. It was quite a surprise to the Fed. And after all, the election of Donald Trump will likely require a comprehensive review of past agreements that unfairly penalize the American financial system in areas as various bank capital, insurance, derivatives, systemic risk, and asset management. And they noted the secretive structures of these international forums must also be reevaluated. Agreements like the Basel III Accords were negotiated and agreed to by the Federal Reserve with little notice to the American public, and were a result of opaque decision-making process. Now that's actually the part he's actually accurate about, the opaque decision-making process. But the international standards were then turned into domestic regulations that forced American firms of various sizes to substantially raise their capital requirements, leading to slower economic growth here in America. And so it's incumbent that effectively the Federal Reserve cease all attempts, this is kind of like the thing that you do in the regulatory world, the supervisory world, you issue a cease and desist order to banks. You're doing something really bad. So he's effectively issuing from Congress a cease and desist order to the Federal Reserve to cease these secretive, opaque negotiations that obviously foist international standards on the hapless, ignorant United States. I won't go into comments about my adjectives there as to whether it's true or not at this stage in my views. But let's just say that there's this view that's oftentimes brought out in the United States. It's really kind of a red herring of that the international regulatory standards are foisted on the United States and they're binding in some fashion, not unlike the Paris Climate Accords, which of course are advisory and aren't technically binding on anybody under any kind of form of law, soft, hard, or indifferent. But nonetheless, we're the United States has withdrawn from the accords because of the binding effect and negative effect upon U.S. industries, even though they're entirely something that you have to self-institute. Similar to international standards broadly, there's this view that the U.S. is subject to these standards, and it's really, for those who've been involved in the process, for those who've studied the process at all, it is truly a red herring. It's something where the U.S. has been a very active participant. I think it's fair to say that since the financial crisis, the U.S. and the UK predominantly have been the real parties pushing for stricter standards, higher capital, higher liquidity standards, resolution planning, new resolution frameworks, liquidity standards that have gone up quite dramatically, and a variety of other standards that are designed to address some of the issues that came out in the financial crisis. So I'm not really commenting on whether, although we certainly can have that discussion, I'm not really commenting on whether the regulations or the standards themselves are good or bad. Certainly, I think it is true, however, that having standards set by the regulators is important to some degree to set the rules of the game. The rules of the game can be set, as Rose was talking about, both by market set rules, by participant set rules, as well as by government set rules. I would say that there are some rules to the game that inevitably have to be set by the government authorities, including things like insolvency standards, various commercial law standards, etc. The regulatory environment we're in today, of course, is very prescriptive, but that's not at all surprising because we've all just gone through a very destabilizing financial crisis that cost trillions upon trillions of dollars to the constituents of the regulators and the national authorities, and continues to roil the world markets. And so it's inevitable that there would be much stricter standards. The question is, how do you balance those standards for future economic growth? And I think that's where the debate properly lies. It's not about whether or not the United States has standards foisted upon it. In fact, the thesis of my paper, which I think is really kind of a critical question in some ways, and I think is one of the most critical financial issues, economic future issues, if you will, during my lifetime, is that we have a very rapidly changing world economic system. The global financial system in many ways is one that has been developed over time, really originally in some ways by the UK, and then oftentimes by the United States after the Second World War, when it became more dominant financial and economic power in the world. And I think the U.S., by and large, there are certainly exceptions to this, has served a very important role over the decades since the Second World War as the medium of exchange, quite clearly the medium of exchange on an international perspective, as well as being effectively to a degree the guarantor and in many ways arbiter of the world financial system. I think the guarantor part was shown in some ways by the activities of the U.S. Federal Reserve during the financial crisis in helping to provide additional funding for institutions in Europe and elsewhere that were significantly damaged by some of the investments and some of the illiquidity that occurred prior to the financial crisis. And I think that was a critical factor in helping to stabilize things at some degree, at some level that would have been much more destabilizing otherwise. And for the U.S., if it were to choose to do so, to disengage from its prior role as a kind of a leader, if you will, in the world financial regulatory space and the world financial systems, would be, I think, very destabilizing to the world economy, would likely lead to changes in the way the global financial system is structured that might not be particularly beneficial to either U.S., Europe, or many other free market economies. There's no question that going forward we're going to be moving into a multipolar world where there will be a lot of other financial centers beyond New York and London. The question is really kind of, in my view, how do we define what that financial infrastructure and that financial system will be? And I would hate to see that system go into an even less transparent process with less free trade, less free movement of capital, et cetera. Although those certainly can have negative and destabilizing influences at times, and it's been shown repeatedly, they certainly, I think, are, as kind of like the statement about democracy, it's the worst form of government, but better than all the alternatives. I kind of feel the same way about some of the current structures with the financial systems. My personal comment, as I mentioned to somebody prior to the session, is that we're now in the United States testing that statement as to whether democracy is better than all the alternatives, but we're trying our best to muddle through. So I think, to me, those are the critical issues. The paper goes through in a lot of detail about the U.S. role and the value of international standard setters, about the growth and development of capital and other standards over the many years since the Second World War. Certainly all of those advanced significant changes to capital standards or other standards, really, as you know, are the result of crises. We saw dislocations in the Herstatt situation. We saw dislocations after BCCI, and there was a need for a more common, at least a more coordinated, if possible, supervisory framework. There were growth and developments over the 90s as well, the 80s and 90s. The U.S., of course, responded to the financial crisis in the United States in the late 1980s and early 1990s with additional capital standards and additional requirements for lending. And I would say that in a particular point of fact there, with additional controls on the flexibility actually given to the regulators to defer the closing of insolvent financial institutions. So that actually put a little bit more discipline in the system, although I've oftentimes heard it said that the type of prompt corrective action framework for supervision of banks puts in place too many constraints on the flexibility of regulators. And as an aside, I usually heard that comment being made prior to the financial crisis, when everyone wanted to exercise great flexibility, which in my experience always has been keeping alive woefully insolvent financial institutions. But I also always have pointed out that prompt corrective action itself gives you the ability to exercise flexibility and discretion to keep alive woefully insolvent financial institutions if you want to, because the standards are based upon judgments being made by the supervisors. And so if you don't make those judgments that the capital is impaired, you can continue down your merry way for quite a while. So you had those new developments coming into place in the United States, and a number of other countries began to adopt standards similar to those in the 1990s. You had in the later 1990s something I thought was quite interesting, or the middle through the later 1990s, and something I was involved in quite a bit. Again, aside, which I probably didn't tell my boss at the time, in the financial crisis that's just occurring, quite how much I was involved in it, was the development and expansion of securitization in the United States under accounting standards and supervisory standards, allowing much easier access to the securitization markets by being able to move assets off balance sheet of banks, which effectively had the result, if you look at the reputational risk of letting your securitized structures fail, of greatly leveraging banks. So you learn things as you go through life. So you had that. You also had the clear demonstration, to Rose's point earlier, I think it was demonstrated in the late 1990s with long-term capital management, where you had clearly demonstrated that it was not just in banks in which contagion could occur. It could occur in a variety of different guises. It could occur in securities firms, investment firms, hedge funds, and others. Now, there's clearly in long-term capital management quite a connection with the banks that were investors in long-term capital management. But it's the illiquidity of the markets in which it invested in, and the loss of value in those markets, and the loss of value on the balance sheets of other entities that created the contagion impacts, and kind of illiquidity of markets generally, I think, was one of the lessons there. So you had these lessons going on through the 1990s. This was in the very late 1990s. In 1998, you had the Asian crisis. You had a number of different effects, but the U.S. Housing market continued on very happily for a historically long run without significant resets in housing prices, and as a result, there was increasing leverage through the securitization structures, increasing irrational exuberance in the housing prices. They would always go up, and then there was a reset that occurred when people couldn't pay their mortgages, and the mortgage structures themselves were incapable of being repaid on the income of the borrowers. You had a reset, and so we had in the United States a significant, I think, failure to recognize early on what was happening in 2006, 2005. You could have seen the prices going up at that point, but in 2007 even in early 2008, there was very slow reaction by the U.S. government to the housing market crisis. I participated in a number of meetings in which it was, I won't name names for obvious reasons here, but in meetings with a lot of very senior government officials say it was impossible to persuade that we actually were having a significant reset in housing market prices, and as a result of that, a significant reset in the value of mortgage-backed securities, and that the mortgage-backed securities, by virtue of the investments that had been viewed as a very positive feature earlier in the period of being diversified across the market, were now in everybody's balance sheet. And if those mortgage-backed securities and their actual value was opaque, it was going to mean that the mortgage-backed securities across all these balance sheets would be uncertain in value, and so therefore the value of everyone in the marketplace would be unclear, and the market would react negatively to that. And that's clearly what happened. I wish I could say that I was quite so omniscient and was able to see that in advance, but you can certainly see that the information available to bondholders in the mortgage-backed securities market, we at the FDIC did make this point very early on, and I give a lot of credit to my then boss, Sheila Bair, as chairman of the FDIC, for saying that there's a serious problem in 2006. You can see that in some ways with the way the market had surged up, the serious problem being in the opacity of the underlying investments, and the fact that it was all over everybody's balance sheet was going to create a serious problem. And I think that's something that took a long time for the U.S. government to recognize. And so you did have a serious reaction with additional government regulation. In 2008, 2009, there were a lot of steps taken, of course, to try to stem the crisis. In 2008 and 2009, and this is sort of to the point of the long-term international standards, there simply was not an international standard about how to deal with these situations. There was not an international standard about the insolvency framework that needed to be put in place, or actually even the recovery framework that needed to be put in place, because everyone was of the view that the ad hoc processes in the past had worked quite effectively. There were commitments, of course, by regulators within the European Union to coordinate and cooperate on cross-border institutions that might affect the systemic risk in their economies. And I think most dramatically of the Netherlands and Belgium, and there were some others as well. And the ECOFIN MOU that was signed, as I recall, in May of 2008, promising all these efforts to coordinate and cooperate, I don't believe was ever taken out of the file cabinet in the fall of 2008. Because there was not that coordination and cooperation, unless you view from game theory brinkmanship as being the epitome of coordination and cooperation, which is what actually occurred. So we proved without a shadow of a doubt that the infrastructure was inadequate, that the ability to coordinate for cross-border institutions was insufficient, and the legal frameworks within the national states was insufficient, and I certainly include that to be true within the United States. The United States, I think, had a very effective, I shouldn't say very effective, had an effective legal framework for addressing insolvent banks. It had a completely ineffective or non-existent legal framework for effectively addressing insolvent owners of those banks. So in the United States, of course, you know, banks are owned by what I refer to fondly as deadhead holding companies. They don't actually do any operations other than issue debt and equity and raise money for their subsidiaries. That makes them the perfect candidates, however, for a resolution, because if you resolve something that's not actually active in the systemically important activities of the underlying financial institutions, then you might actually avoid having to close the underlying financial institutions that are active in those systemic markets. And so the United States had no way to do that. We had the U.S. Bankruptcy Code, which although I view personally as a very effective framework for insolvencies of corporates and a variety of other entities, is woefully inadequate for dealing with liquidity crises that affect financial institutions that are active in the market. So the United States was certainly sharing in that. And so there was a push by the U.S. and the international standard setting bodies, and I did participate in this, to move towards standards that would be more effective on an international stage in dealing with insolvency and resiliency, so that at least we had something that could provide for a framework that would allow you to deal with these issues going forward. Now, you could question whether the framework that was ultimately designed through the Financial Stability Board and was actually incorporated in the U.S. Dodd-Frank Act and Title II of Dodd-Frank Early Liquidation Authority prior to the FSB key attributes, and more on that in the comment about the effect, about the international standards being foisted on the poor, innocent United States. But you can debate about whether those standards are effective to actually deal with a multi-institution crisis, such as we had in 2008. In some ways, that's an important issue. I don't want to disparage that at all. But in some ways, that's a little beside the point, because in part, what you're trying to do with those standards is to reset the market expectations of what would happen in a future crisis, so that the market expectations are not exclusively focused on the idea that it will all be bailed out by the government, or that there will be some solution found. Because I've always been of the view that one of the big problems and turning points in the financial crisis in the United States, putting aside the mortgage issues that were the underlying problems, was that there was at least a perception among some that the solution provided with additional lending to allow for an assisted merger between Bear Stearns and J.P. Morgan in the spring of 2000, March roughly of 2008, created difficult expectations when you had Lehman and others being in trouble in the fall of 2008, and then that similar type of solution was not chosen for Lehman Brothers. So those expectations are things you're trying to reset, I think, with the insolvency standards that were put in place, and with many of the other regulations. I would not debate that all of the regulations that were put in the U.S. or internationally are all a positive feature since the crisis, but they were trying to reset the expectations of the market, to set rules that the market has to go by that will then have an impact upon how the market functions. Certainly, there's a strong, and I think to Rose's point earlier, it would be best if we were all wise, and if democracies were wise and made a choice to put in place financial regulations that were sound and prudent long before crisis. But the reality is you can never waste a good crisis, because you're never going to have the political will to actually do anything with regards to the regulatory environment until there's actually a reason to do it, because it's the oldest rule in the oldest standard, I would say, in the supervision of financial institutions is nobody ever wants to take the punch bowl away in good times. So, you had Greenspan's quote that Rosa showed about his shock and dismay, and I almost feel a little bit like, because Greenspan's not an unwise person, or I almost feel a little bit like the line in Casablanca where, you're decrying, I forget his name, the captain is decrying the gambling going on, oh, here are your winnings. You know that if you allow a risk to build up and leverage to build up in a system, there's going to come a reset at some point. And maybe that's something we simply live with, and we simply conclude that that's what governments, central banks are for, to provide the funding to allow that reset to be a soft landing. I personally think that it would be much better if we tried to make sure that the market provided discipline on those institutions that were getting a little irrationally exuberant, and that the market itself would help to prevent, or at least to limit, the type of buildup of bad assets and leverage in the system. And I do think that government regulations play a role in helping to set the standards from which the market operates, and hopefully will increase the levels of market discipline to help prevent that. And we should not rely on the government or the central banks to bail us out every time that we get kind of carried away, because it does create, I think, huge political problems. And it has certainly created huge political problems in the United States, and I think in a lot of other countries, where the public is feeling, why should the large banks be bailed out when we, the people, have suffered enormously by having our houses underwater, by having a variety of other negative consequences, losing jobs, etc. So why should the banks be bailed out? Now there's an answer to that, of course. If the banks aren't bailed out and dealt with, then you have much deeper depression and much greater effects upon the economy, and you'd lose even more jobs. But that's a very hard argument to make to the public. It's hard enough to make the argument that the activities the actions that were taken in 2008 and 2009 in the United States, which I'm absolutely convinced prevented the U.S. economy and probably the world economy, the world financial system, from going into a much deeper depression than it would have, than it did. But you can never, it's very hard to prove to anyone that prove a positive, prove a negative, that you would have, we didn't avoid this. We avoided this because of all the actions we took, and we should get credit for it. Instead, what we've had is political roiling in the United States, which has led, I think, quite directly to the election of Mr. Trump as president, because of people's dissatisfaction with the responsiveness of the government. And my own personal view, this is definitely covered by footnote 1, which says nothing that I say reflects the views of any of my partners, Cleary Gottlieb, or any of the other people I cite in my footnote. That and the very effective propaganda that has kind of roiled the U.S. governmental system since the crisis. But there's a direct relationship between financial crisis and political consequences, and I think the absence of good regulation and financial crises. Bad financial regulation, too strict financial regulation, is something to be avoided, and we're now stuck, and have been for the last 8 years, over to this side of the pendulum, depending on your perspective, this side or this side, but we're stuck on one side, and we need to moderate the regulations back towards the middle. And I think in some ways we are in the process of doing that. That may be the sole positive response from the election of 2016. There will be some, I think, moderation in some of the regulations. For example, today in the United States, the binding constraint on large financial institutions is not per se the regulatory capital or regulatory liquidity standards that are put out through notice and comment rulemaking. As a lawyer, going out for comment and trying to get feedback actually is an important thing, I think is a good thing to do. The actual standards in many cases for the largest financial institutions are set by the resolution planning rules, because the resolution planning rules have put in place standards that you have to do analysis and do an assessment of the capital that you would require in a crisis, with a severely adverse scenario being the primary baseline scenario that you need to look at, and the liquidity standards that you would need throughout certain periods of time in order to maintain liquidity. That all makes perfect sense from a resolution planning perspective. You should look at the worst case scenario. You should look at the capital liquidity you need. But if those standards end up becoming the binding constraints on financial institutions, independently of the normally set binding constraints under capital and liquidity standards, I think that's a dangerous process to go through, and one that needs to be reconsidered. And there are a number of other aspects of the current rules, I think, that come into play in that area. 2 minutes. It's funny, when I started out, I said, this is something that's as obvious as the nose in your face, but doesn't stop me from yet rattling on about it. But I think it's really critical that we look at regulations as being ways of setting standards that the market should go by. And I think it's equally important, this is the part about your nose is as obvious as the nose in your face. It's equally important that the U.S. remain a positive, engaged party in these international standard setting bodies. Make sure that the implementation, along with other countries, is done in a reasonable way. And I think actually one of the interesting things about the new Trump administration's Treasury Department is that all the signals to date are that Treasury will remain engaged, and in fact it's signaled in some of its reports that it wishes to make sure that to continue implementing some of the Basel capital standards and working with international standard setting bodies. So that's quite encouraging to me, because I think if the U.S. were to abdicate its role and responsibilities in these areas, then I think other countries would most reasonably look to other parties as being the ones to look to be a reliable role player and a reliable party in international standard setting and international financial markets. And I think that can have negative consequences, certainly for the U.S. and certainly for other countries. So are the Basel standards anti-American? I think that's kind of not the question. The question is, how can the U.S. continue to play an engaged role in the standards? One of the things that I will be looking at very closely, coming out shortly, although it's now I've been advised it's been deferred pending the future failure of tax reform in the Congress, is the standards, or is the report that's being put out by Treasury on the Orderly Liquidation Authority and the resolution standards that were put in place in the United States. The reality, of course, is that those standards are the international standard. The OLA provisions, although put in place prior to the FSB standards, as I mentioned before, are really kind of the FSB standards. You know, I worked a lot with a lot of colleagues from all over Europe and Asia on the FSB standards, and prior to that in the cross-border resolutions group that Eva Hupkes and I co-chaired at the Basel Committee. And they're really kind of common sense flexibility, common sense ability to implement transactions, and common sense standards, I think, of how to do an insolvency process that would make sense on an international basis. So if the Treasury report were to come out and recommend the elimination of the Orderly Liquidation Authority, I think there would be a significant retrenchment, and I would expect negative consequences to occur by European governments and the UK government as well to desire to eliminate OLA, because it would then show that the United States was not going to be a reliable party in these types of discussions and in working out what to do with large, complex financial companies, as I think they've been the United States has been a reliable party in the past. However, I do not expect that to be the recommendation of the Treasury Department. I expect them to recommend keeping OLA, and perhaps I expect them to make some, hue and cry about the moral hazard of having a liquidity fund as part of OLA. But I expect them to actually recommend that some form of liquidity fund is necessary. But we'll see if politics trumps rationality, and I'll stop there. Thank you.
Thank you very much, Michael.